Hi, this is Mitch Allen with the Advanced Financial Alpha team. Bringing another video to you. Um, it's my second time recording this one, actually. I went on about a 10-minute rant about it the first time I tried to record it. But it's about Roth versus traditional, or more simply put, post-tax retirement savings versus pre-tax retirement savings. And that can be within an employer-sponsored plan like a 401k or a Roth IRA or even a backdoor Roth. What I have here is just an example that I put together, dinkytown.net financial calculator. But we'll go through this and I'll just touch on some points. So this particular case, we got contributing $7,000 per year, which is what you can currently contribute to a Roth IRA. 30-year-old saving till age 65, expected rate of return 8%. I wanted to use a fairly high tax bracket, current rate 50%. Highest bracket right now, 37% federal and potentially 13% state, depending on which state you live in. But during retirement, having that cut in half. All right. Some numbers here. The amount going into the actual retirement account, right? On a pre-tax basis, 245,000 into the Roth, 245,000. Now, this particular calculator assumes that your value tax savings, you're going to actually save that additional amount. I can tell you from experience, this is not the typical case. This number may be inflated by a large amount. Potential taxes during retirement and what the value is at the end. As you can see, Roth still comes out ahead. Part of this is time value of money related, but some things I want to touch on with this. In this scenario, 81% of your overall nest egg is from growth. So the first question I have for a lot of clients is, do you want to pay taxes even at a higher rate on 19%, 20% of your portfolio? Or do you want to pay taxes on 100% of the portfolio, even at a lower rate? Also, this assumes that you're going to just take that withdrawal and only pay that lower rate on the flat amount that you have at retirement age, right? At age 65 in the pre-tax portion, 1.2 million. Now, if you do a good job of planning, you're going to stretch those dollars out and you're going to have some growth during retirement as well. Taxes will not just be paid on 1.2 million. It'll be paid on a much larger amount by the time all is said and done. Odds are, hopefully, you're going to live for another 25, 30 plus years during retirement. And you'll be paying taxes throughout that whole time, even at a lower rate. Another rule change was how inheritance is taxed. You pass on pre-tax money to your kids, they're now required to withdraw that amount in a 10-year time span. A lot of times they're inheriting that money in their highest income earning years. So who knows what tax bracket they'll be in at that point, but this will be tacked onto that. So tax-wise, you'll be paying a lot more in taxes. Also, we have a thing called required minimum distributions for pre-tax money, RMDs. Currently at age 73, the government says you have to take out a percentage of income or of your nest egg each year, and that amount increases each year you get older, where you get into your 90s and you're taking out double-digit percentage of your nest egg and paying taxes on that, losing a lot of control on how much taxes you actually have to pay. So you could argue that, yes, your tax bracket will be down in retirement, but when RMDs kick in, you don't have a lot of control of what tax bracket you're going to be in, and you're going to pay taxes at those rates. This is why I argue that if you can take advantage of Roth in any form, you should be doing it. Now, I encourage you to talk with an accountant, talk with your advisor, and make sure it fits because there are other arguments that, hey, this is talking about future you and current you should still have an enjoyable life because we never know when it could end. So keep that in mind when doing any of this planning to think it through, but we should all be taking advantage of some Roth dollars, in my opinion. Thanks. Have a great day.